Good afternoon, traders and investors. Will back here with another one, coming to you with another edition of our subscriber request videos. And in today's topic, guys, is going to be a very interesting one. We are going to tackle the topic of renewable energies and the major players in that industry. Now, the thesis is as follows, guys. With a lot of heightened demand on the infrastructure for electricity in the United States because of hyperscalers ramping up data centers and potentially new AI applications alike, there is going to be a lot of demand for electricity in the foreseeable future. So that puts a lot of pressure on the existing industry and could potentially open the door for some new players into the game. So in today's video, guys, we're going to go over a few subscriber requests that we got over the course of the last week and a half. Take a look here. PO Box asking for a review of VST, CEG, NRG, and TLNE. Then we have testing the waters below with a few solar stocks as well, Enphase, FSLR, and NextEra Energy, which isn't truly solar, but is one of your larger energy providers in the United States. Then obviously Roman coming in as well with CEG and VST. And lastly, Chingy with another analysis on CEG. So appears as though everybody wants to look over a few of the same stocks because they have ran a ton leading into this year, pretty much due to the NVIDIA effect, right? The ramping up of data centers, and then obviously traders and institutions trying to front run the potential electricity heightened demand trade. So today's video, guys, a lot to cover in terms of those stocks. So I figured I should pretty much give my analysis on it and pretty much an overall thesis behind this trade. Now, keep in mind, guys, I am by no means a commodities specialist and also by no means an electricity focused specialist either. You really need to be a veteran in the game to understand this industry to the degree that it requires to be analyzed properly. But however, just based on my prior experience doing analysis on other companies, I figured as though I should put in my 2 cents for anybody that was willing to listen pretty much, right? So without further ado, guys, let's get right into today's video. So in terms of the energy sector, guys, let's take a look here at a few of the common themes here and one of the major theses that is currently running around in the market. So the thesis is as follows. Renewable energy will be more desirable in the future because of AI and data centers, right? They will require robust infrastructure and heavy investment into electricity generations. Now, one few of the drawbacks that I wanted to cover on the sector, guys, which is one of the reasons that I really never invest in overall utilities companies or commodities companies as a whole. Here are the reasons why I tend to avoid the sector. Now, number one, it is highly competitive and highly regulated by the government. Highly competitive, guys. There is over 100 different electricity manufacturers in the United States, and it is obviously location dependent, right? So choosing which one is quite a cumbersome analysis. Number two, new renewable players versus the legacy players. Now, obviously, you have a lot of lobbying going down, which is we're going to cover in the next point, but legacy players, just think of natural gas and oil producers. This is versus the new renewable players operating more in the renewable sense of either solar energy, nuclear power, which has seen a nice resurgence in the last couple of years, and just overall electricity generation, which is viewed to be as more a cleaner energy source, right? Now, number three, this sector is highly dependent on government legislation and lobbying, right? We see that with the whole current political climate of Biden versus Trump. Biden obviously promoting a lot more renewable energies, and Trump is more known to be someone who favors the oil industry. So depending on who is currently at the helm in terms of the presidency, right, you may have different things happen, which is why this is a very big point in my opinion. Number four, a lot of these companies have mostly thin margins and inconsistent free cash flows. If you want a cyclical business, guys, these are the kings of being a cyclical industry. They can have a very nice boom period for 3, 4, 5 years and then do absolutely nothing for the following 5 years, which is why inconsistent free cash flows and thin margins leads me to stay away from the sector for the most part. Now, number five, new projects require immense capital expenditures and time. Obviously, if you want to start a brand new electricity generation project, whether you're using solar, whether you're using nuclear, or just maybe even hydroelectricity, it's going to require a lot of upfront investment, and the time to build these projects is usually in terms of 2, 3, 4, if not 5+ years to get all the regulatory approvals and then obviously ground break on the site. Now, number six, tax credits and subsidies make or break these firms. Obviously, this is state by state. California will have different subsidies and different tax breaks than, let's say, a state like North Carolina or a state like Texas, right? So you really have to be extremely knowledgeable about what percentage of these companies' revenues is generated either by straight output versus the amount of money they get from tax breaks and benefits, which is a cumbersome analysis as well. Now, number 7, picking the right company requires industry expertise, guys. And this is one where you really have to know what you're doing, in my opinion. Even someone like me who has a lot of financial analysis background and exposure to a lot of different companies, guys, I would never say that I'm even close to having the knowledge required to analyze this industry to the degree that it needs to be analyzed, right? You really have to know exactly what you're doing in terms of megawatt per hour output, in terms of capacity generation, and a lot of different factors that not a lot of people are very knowledgeable about. You really need to be an industry expert to have any sort of alpha in this entire industry as a whole. Now, before last, it is highly location dependent. These companies cannot service everywhere, which is why there is just so many of them, right? There is not one clear winner in the United States that can serve the entire country and that has the infrastructure to do so. It is mostly state by state dependent and geography dependent as well, which is why there's just so many different players in the game. But a little tidbit here, guys, in terms of location, right? If the thesis that you're going after is for AI and data center power, well, you really want to look at where are these companies building their data centers for the most part, and then derive, once you have those locations, derive which energy companies are the leaders in those sectors, right? That is going to be the number one thing that you guys should do if you're looking for this as your main thesis. And now, the last point here is it's very difficult to determine a competitive advantage or a moat, right? When we take a look at legacy companies that we cover all the time, like Apple, Microsoft, Visa, and the likes, we obviously know what their competitive advantages are and what is their moat. However, for energy companies, it is definitely not so clear. For one company to have a net competitive advantage over another requires a detailed analysis. And even after a detailed analysis, guys, sometimes the comparisons just aren't so clear which one is the clear winner above another one. Some companies will have better output numbers. Some companies will have better bottom line profit margins resulting from that output and from tax credits and subsidies. But the competitive advantage as to who is the true best power generator is really just up for discussion every single time. So those are all the drawbacks of the energy sector. Those are the ones that keep me away, but those are also the ones that you should also understand if ever you are investing in this sector. So without further ado, guys, let's move on directly to the analysis, and we're going to pretty much start it off with a broad view of the energy market. So starting off, we're going to take a look at the general thesis, right? Is electricity generation going to be the way of the future? Well, take a look here, guys, in terms of your renewable energy sources, wind and solar. Those have been having a very nice energy uptick over the past couple of years. Ever since 2018, their percentage of overall output is growing. Natural gas is obviously still your industry leader, although they have come down a slight bit since 2020. They're still sitting between 35 and 40%. Coal is the one that is losing towards everybody because it is pretty much the dirtiest of any energy output. Nuclear is pretty much holding steady despite a lot of renewed popularity in the industry. The output amount is just not really increased since 2018. And that's because to start a new nuclear power generation facility, guys, it requires an immense amount of approvals. And then obviously constructing the actual site can take potentially years to come. And usually in the past 10 years, governments haven't really been that keen on approving nuclear projects, especially close to otherwise known as residential areas, right? So you really have to have a good location for it and a local government that is really pushing for that service. Now, keep in mind this as well, right? You can see this chart blown up even more. Natural gas progression, nuclear projection. Coal is really the only one that's been steadily coming down. And what's been replacing coal has been your renewables. Hydro, not so much. Even though in Canada, that's our main source of generation. In the US, not so much. It's really been a case of wind and solar really starting to take some market share from your coal production. The other two main ones really remaining flat pretty much. As a whole as well, let's take a look at some data center analytics right here. So here is some research by Goldman Sachs. This has pretty much been put in roughly this year, just about 2 months ago. We expect, this is what Goldman Sachs say, we expect data centers to comprise 8% of US power demand by 2030 in our base case, with potential for 11% in the bull case and 5% in the bear case. So here's your data center demand as a share of total US power demand. And you can see the total addressable market is definitely growing. The bull case is this gray line right here. And this is pretty much your on par case, right? The normal case of expansion in terms of AI demand. You can see it's going to take more and more of that US capacity coming up. So this trade, even though it is just in the beginning, can potentially have some legs in a few years down the road, more specifically, really starting 2028, 29, and 2030. So still a lot of time left on the table for this trade to play out. And for the larger players, the winners of this entire thesis to really start popping out, right? Now, moving into more analytics on data center demand. So take a look at this, guys. Midstream gas companies. Yes, I'm pretty sure a lot of you didn't know, but a lot of electricity generation is done through natural gas still. Now, here's your data center demand. Midstream gas companies, including Kinder Morgan and TC Energy, were confident of continued growth in demand from power plants during Q1 earnings calls, often citing demand from data centers. U.S. utilities also struck a bullish tone, partially from data centers. Commodity Insights power analysts are less bullish. Growth from data centers is expected to be substantial, but below utility forecasts, owing to significant data center electric energy efficiency gains. That is something that nobody talks about, how they're becoming more and more efficient. So even though the ramping up has started, nobody talks about these companies that are able to produce the same amount of output using less power. That is something that NVIDIA has been talking about a lot over the past year. So I would not be surprised, guys, if the demand is partially offset by increases in efficiency. That is something else that we have to keep a close eye on. Companies driving the data center build-out, like Microsoft, Alphabet, and Amazon, have strong incentives to improve efficiency and minimize environmental impacts. Major chip suppliers, including NVIDIA, have announced huge efficiency gains in their next-generation chip designs, the analysts wrote. Outside of chips, AI models can be configured to be more energy efficient, such as by using fewer bits. More water-based cooling mechanisms are emerging as an alternative or supplement to air cooling, further reducing energy use. This is going to be something we need to keep an eye on, guys. As I said, the increase in demand may just be offset partially by improvements in efficiency. So the demand numbers that we're currently seeing right now may not paint the full picture. Now, one last thing that I had for you guys, this ties into my pretty much location dependent analysis, right? Here is a map of all the data centers that are currently located in the US. You can see that most of them are located in Virginia, followed closely in second place by Texas and California. So if I had to choose some stocks in terms of a general thesis around data center demand for power, I would be looking for any and all companies that are building data centers around here, Virginia, think Virginia and North Carolina, and think Texas and California. Those would be the main hubs that I'll be looking for companies to invest in, just because of the sheer amount more data centers that they have than as opposed to anywhere else in the country. So that is pretty much our preliminary analysis and just an overall industry analysis in terms of renewables, in terms of this thesis right here for AI data centers. We're not really talking about consumers, right? Just the consumer side of energy consumption. We're really tackling the industrial side of it, more specific to AI and the data center build out and rollout, right? So let's get into a few companies, guys, and we're pretty much going to cover about 6-7 companies right now. We're not going to take too much time on these, but at least spend enough time to paint somewhat of a broad picture and whether or not I deem the stock to be a decent position. So first off, we have VST. Now, obviously, this company has come leaps and bounds from just last year, but don't get it twisted, guys. A lot of this rally has been because the company has bought back a tremendous amount of shares. They have bought back 28% of their stock since 2022, after pretty much starting this NVIDIA-based rally around the data centers, right? Take a look at your Vistra shares outstanding. You can see that stark contrast, which pretty much started in the early part of 2022, and they've been buying back shares aggressively. So when you see this EPS growth rate, guys, it is heavily tilted because of their massive share buybacks. Now, what this company does is they're pretty much a jack of all trades. They have exposure to energy production in all of your major categories: natural gas, nuclear, solar, and battery storage. They're actually one of your industry leaders in the battery storage segment. Now, the free cash flow. How is the free cash flow, guys? Let's take a look at the balance sheet number one, as we always do. Take a look down here, guys. You will see they have a decent amount of debt still, about 14.69 billion. Their free cash flow generation as of 2023 was decent, but you can see it's very, very inconsistent on a quarter-over-quarter basis. Some quarters, they're positive free cash flow. Other quarters, they're negative free cash flow. Their debt, however, just continues to mount as establishing new projects is very expensive, as we've went over, right? So positive free cash flow, but highly inconsistent, which is why I don't really like this business model that much. Now, moving on to the EPS and revenue growth, you can see at least EPS is heavily growing, but once again, the data is slightly skewed just by the amount of buybacks that they do. And in terms of revenue generation, the revenue is growing quite substantially as well, so no problems there in terms of top line revenue growth, although it's a little bit light at about 6.5%. You really want to find companies that are growing this top line revenue above 10% per year. Now, that being said, guys, in terms of the valuation, right, we have to take a look at the valuation. So the valuation here is not that bad considering how high they're growing EPS. Now, their forward 2024 PE at $89 is about 17.58. At a first glance, that seems relatively small, and it is, especially when we divide that by their EPS growth rate. It gives them a PEG ratio of about 0.62, which does leave us to believe that the stock definitely has more upside, and a lot of analysts do agree. Most of everybody has a strong buy rating on the stock, and you can see price targets, the midpoint is about 116, but it does go all the way up to about 133. Now, that is pretty much your 1 year price targets. But in my opinion, guys, the stock does potentially have further upside, but you have to be very wary of inconsistency in free cash flow and net margin growth. And you also have to be very wary of potential this current presidential election as well. If Trump does win, guys, will this potentially hurt the renewable energy sector or not? Well, at least these guys have a massive position in natural gas generation. So that will pretty much offset any reductions in their solar or maybe even battery storage industries. But still a very strong company. Can't take anything away from them. It's just a shame, guys. I'm pretty sure that a lot of this trade is already behind us. There are some gains to be had in the future, but in my opinion, the marginal benefit of this trade versus the risk may not be worth it for most people. Take a look here, guys. At least they are growing. This is directly from their earnings report that came out roughly in the month of May. New demand powered paradigm in powered markets. You can see US data centers. This is their data directly. By 2030, we have an increase of 35 gigawatts. And actual and projected peak demand, you can see peak demand is actually going to rise, and actual demand is going to rise as well. Throughout these years right here, 2021 to 2023, the data center ramp, that has been pretty much their best years right here. And you can see thereafter only about a 1.6% compound annual growth rate. So not the best. ERCOT is basically their position in the Texas market. So their Texas market will be growing at about 6% per year. Very good. But the overall dynamics of the market are not projected to be the best here, guys. So growth definitely not going to be as aggressive as it has been back there, which is why I'm saying we're probably not going to see continuation of this uptrend in such a fashion like this, right? It may just be something like this would be more agreeable for this stock. That being said, guys, as I said, the valuation is not that bad, but it really relies on these growth projections being accurate. Anything that slows down this growth, and there are many factors that can slow down this growth, just took a look at all of these potential drawbacks. Every single one of them can potentially affect that growth. So in my opinion, just due to all of that uncertainty, unfortunately, this one is not a buy for me, just because the risk reward at this point does not make sense, guys, in my humble opinion. And that's just my say on this stock right here. But if we're looking to play it for a little bit of a swing trade, we can always do that. No problem at all. So take a look right here, guys. We can take this with a little bit of a swing trade, but the stop loss, in my opinion, needs to be super tight, right? The bulls are currently trying to defend this weekly uptrend. We have been in a weekly uptrend, guys, pretty much all year since the start of 2023, or pretty much 2023 into 2024 as well, never losing the weekly uptrend. So we are trying to play this stock for the continuation of this weekly uptrend, which is why the stop loss needs to be very, very tight in my opinion. If we lose this weekly uptrend, that could lead to potential further monthly consolidation. And since we are so heavily overbought on the monthly RSI and even the weekly RSI, not too bad right there. Any further rollover, guys, will be a catalyst for the stock to roll over on the monthly. So if you want to take a little bit of a swing trade, I am not opposed to it, but we have to take a really, really tight stop loss, guys. Upside targets, you really need to be in line with your all-time high, and then maybe some of the analyst targets about 116, 130. The stop loss, however, needs to be very, very tight around the $82 mark, because if we were to close below that mark, it really undermines the capacity for the bulls to really continue this gorgeous monthly expansion in one clean shot before any consolidation. So that is just my take on the matter, whether it be for a long-term investment, not for me, just because it's very inconsistent and unpredictable. But potentially for a swing trade, I would not be opposed to making a little bit of a swing trade just because it is an in-favor trade as of right now. Now, moving on to stock number 2, we're going to cover Constellation Energy Corporation. Now, they are the industry leader in the USA for nuclear production. They have the most amount of nuclear reactors, and they generate the most amount of demand from them as well. Market cap of about 66 billion, so it is a fairly large company. That being said, this company as well has benefited from pretty much the rise in data center and AI applications as well. And as a matter of fact, guys, their fundamentals they're okay. They're not the best, and they're not terrible either. They run a free cash flow deficit. Take a look at their balance sheet right here. We always take a look at the balance sheet, guys, just to get a general health of the company. You can see their profit margins are relatively slim. This is pretty much in line with the rest of the industry, right? The industry is not known for their crazy profit margins. Now, they have been doing a good job in the last couple of quarters of putting in a few quarters above 13, 14%, but it's just so inconsistent, right? Take a look at their balance sheet, guys. $9.26 billion in debt, and their free cash flow is extremely negative because they are spending a ton of money on capital expenditure to build new projects out currently, right? So free cash flow, unfortunately, still a little bit negative for them. Now, they are also struggling to increase their top line revenues. Take a look at this expansion graph right here for EPS. EPS shows fairly clean expansion, but the revenues is very, very inconsistent as well. As you can see, for the next foreseeable futures, not really expanding on that top line revenue for so much, right? Their current top line revenue for 2024 is going to be about 24 billion, and by 2026, only an increase of $2 billion. Definitely not the best, right? Which leaves them with a revenue growth through 2027 of only 2% per year, guys. That is really not the best in my opinion. EPS growth is fairly decent, however, right? So that's just also a byproduct of them really driving all the money to the bottom line. They have been using it pretty much to do aggressive share buybacks here in the last about 1 year's worth of time, which has helped the stock momentum further to the upside, right? Now, in terms of the valuation here, guys, well, if we take in consideration their 2024 EPS at a share price of about $2.11 right now, their PE ratio is about a 27.4. At a first glance, not so bad. If we divide it by the EPS growth right here, we get a PEG ratio of about a 1.96. That is a little bit high, guys, especially for a company that's only growing top line revenue at about 2% per year. It is not the best in my opinion. Now, the company does have a few positive things, and you can even see an interview by the CEO that he gave about a month and a half ago. They are in talks with hyperscalers for co-location. If you guys don't know what co-location is, it's basically when a company has, let's say, a nuclear power plant. Let's say they have it in California somewhere, right? Well, they are going to be in talks with Microsoft, Amazon, Google, and the likes to potentially for those companies to build a data center right next to the location that is generating the power. That is what you call co-location. And all of your hyperscalers have been in talks with this company to potentially derive some partnerships like that, whereby they develop data centers very close, in close proximity to those nuclear power plants, and then they are provided power directly from them on a predefined operating rate, right? So it could be some very good business for the company, but once again, if they have to build out more infrastructure, you guys know nuclear power plant infrastructure takes so much time to build. Now, take a look at this from Constellation's earnings And you can see they are the best in class for nuclear power generation. That is very true. Now, take a look here at your historical nuclear fleet capacity factor, right? You can see that the orange lines here are the capacity factor. That is the maximum capacity that the company can potentially generate at any given time. And you can see they always operate under the capacity. So they do still have capacity to ramp up at their existing installations. So far, it has not been taken, but then again, they are still in talks with a lot of those hyperscalers. So you could see the company operating at full capacity quite shortly, right? So very decent potential exposure for the company in the future. But as of now, that is still just in the pipeline. No concrete plans as to who they are partnering with and what exact infrastructure installations they are going to make in that respect, right? Now, in terms of the technicals, guys, well, we can obviously, the monthly is absolutely blown out on the RSI right here, but still a very juicy monthly uptrend to say the least. A little bit of consolidation at the highs here. And the same thing, guys, because of the high PE ratio and the low top line revenue growth and all the factors that undermine the energy industry as a whole, guys, this to me needs to be no more than a swing trade in my opinion. So if I'm looking to swing trade the stock here, guys, same thing as we went over with Vistra right before. Weekly uptrend currently in motion. Would not like to see the company lose this weekly uptrend, or they potentially might be due for a little bit more monthly consolidation. That being said, if we're looking for this weekly trend expansion, need to keep the stop loss relatively tight below our weekly lows, because if they fracture this, well, then that undermines our thesis for the swing trade and could just be due for more monthly consolidation. So that being said, guys, I would keep a very, very tight stop loss if I am going to be trading this one myself under 197.63 to be specific, right? Just because it's the line in the sand on the weekly. So if we're looking to take a little bit of a swing trade, I would not be opposed. We're actually coming up into this level right here. So if we were to take the swing trade down and lower maybe 210 location right here, we would have to be targeting obviously the all-time high breakout location. The stop loss would go below that 198.7 because it invalidates the weekly and the monthly continuation factor. Now, keep in mind your analyst forecast, guys, are not that much higher. We do have a lot of analysts saying buy or strong buy, but you can see their price targets are not so much higher for the 1 year moving forward, most likely because of the uncertainty surrounding the top line revenue growth. So analyst targets midpoint about 235, high to about 250s. So that being said, that's pretty much your analysis rundown on Constellation Energy. Great company, love what they do, but the infrastructure is going to take a lot of time to build, and so far no clear path as to who they are partnering with and the numbers that will be generated via those partnerships. Now, moving on to our third company on the list, let's take a look at NRG. So NRG company, guys, also benefiting from a tremendous rally, but you can see, guys, it was not always the case. This company pretty much since 2008, look, could barely get above the $40 mark. Such a highly cyclical industry. But since pretty much NVIDIA started their data center ramp and the hyperscaler started as well, you can see what happened. A lot of front running on these trades. All of these trades look the same, guys. They have been front ran to hell, in my opinion, at this point, which is why the risk reward up here may not be as attractive as you may think. So moving on, the monthly currently overbought as well, right? So just keep that in mind. Now, in terms of NRG, their top line revenue growth is slow as well. So let's take a look at your expansion sheets right here. When we take a look at the EPS and revenue growth expansion, you can see, guys, EPS slightly inconsistent, right? Heavy beat somewhere, and then they're down and then back up, right? So very, very inconsistent. You can even see this on a quarterly basis, guys. Very, very inconsistent in terms of EPS gains, although they are pointing higher for the next foreseeable future. In terms of revenue, guys, same problem, right? Look at this lack of top line revenue expansion. Right? It just goes to show that without being able to expand your top line revenue, do not expect the company to be able to expand its bottom line margins. And as you can see, similar to the rest of the industry, bottom line margins are variable at best, right? The company as of 2023, not profitable, but at the start of 2024, have regained profitability. Just very, very inconsistent and tough to predict. Now let's take a look at their balance sheet, guys. Their balance sheet also paints the similar picture to everybody in the industry, right? A lot of debt, not that much free cash flow, and not that much cash equivalent. So this balance sheet is really not looking the best for NRG, in my humble opinion. Now, that being said, they are the second largest retail provider, and they have about 9 million homes that they generate energy to. So a major part of their business is the retail and consumer segment. The industrial portion of their business is a growing portion of their business, but by no means is the top line segment. Now, the company is attacking the smart home business as well, which has provided them better net margins than the rest of their business. So this could be a very interesting thing to follow along with the company. They seem to be one of the industry leaders in attacking this line of business as a whole, which is very, very niche. Now, as we went over before, they do have significant debt and low to inconsistent free cash flow. So in terms of their, in terms of their number expansion, you can see revenue growth here, very, very weak, guys, at about 4% per year. EPS, though, is expanding about at 7% per year, but none of these two numbers is in double-digit growth. So you can say, guys, the company is growing, but they're just not growing very fast. And because they're not growing very fast, we need to see a very cheap valuation for them, or it's just not worth it, in my humble opinion. That's just how it works. Now, in considering their valuation at $77 right now, their price to earnings is 11.8, which appears to be low, but they're just not growing, guys. That's why Wall Street refuses to give them a higher multiple by bidding this share price to the moon. In terms of their PEG ratio, we divide this PE ratio by their EPS growth, and we can see the PEG ratio is even not that great, guys. 1.68. Anything below 1 is very good. Between 1 and 2 is okay, which is why I've labeled it as okay, and anything above 2 is quite expensive. So this one, in my opinion, guys, is a little bit more on the expensive side, just also due to the cyclical nature of the business and the inconsistent free cash flow that they generate, right? In terms of the trend, well, we can obviously see the monthly uptrend is clear as day right now, in for a little bit of monthly consolidation off of overbought conditions. Take a look at some of your analyst expectations. You can see here that the price targets really vary. The upside midpoint is about 88.84, not too far off the current share price, and we have one person up here sitting around $110. So that being said here, guys, we're going to take a look at the technicals real quick and see if there might be a swing trade to be had. So same thing, guys. Weekly uptrend has been in motion pretty much over the last year and a half, or rather year of trading at this point, but we are potentially in jeopardy of losing that. Keep a very, very, very close eye at this location right here, guys, the 12 weekly EMA. We have not lost a 12 weekly EMA pretty much since last August, essentially, which is a very long time. So in the event that we do lose this, guys, monthly further consolidation may just be on the table for this company as well. So if you do want to take a very tight swing trade, guys, the trade is pretty much right here, right now at about $77. I would keep a very tight stop loss, guys, $75, no more than that, because we want to get this further trend expansion. If the trend breaks bearish, weekly downtrend, monthly consolidation at this point, guys, can potentially take some time. This trade has definitely run a lot, so I wouldn't be opposed to trying a little bit of a continuation bet here for this stock on further. But if ever it falls apart here, guys, and weekly downtrend does occur, then we'll have to be very patient and watch where this chart bottoms out before it recaptures that weekly for another potential entry when we get the weekly uptrend back. That is just how I would play this one. But as a whole, guys, I would not personally be investing in this one, but that is just me. You guys are obviously free to do whatever you like. This is obviously not financial advice, just my take and whether I would invest in any one of these companies. Now, that is pretty much everything for stock number 3. Stock number 4 that we're going to be going over is TLNE, Talen Energy Corporation. So they were a spinoff from Pembina Pipeline Corporation back in 2015, and then they were just most recently listed back on the exchange come 2023 on the over-the-counter markets up here, right? So they're on the pink sheets right there. All in all, though, the company has been promoting very, very decent growth as a whole. And you can see by this chart, guys, right? Another one of these companies benefiting tremendously from the AI and data center ramp. Now, take a look at a few of the highlights, guys, for the company. So the company sold off its data center. It was operating one massive data center and it sold it to Amazon. And thereof, they sold off other assets to shore up the balance sheet. What does shore up the balance sheet mean, guys? It just means that they had a ton of debt and they needed to raise some cash. And you can see that right here, ton of debt 2015. And then when they started relisting their stock back in 2023, you can see a shoring up of the balance sheet, meaning that they raised some capital by selling off assets. And now their debt to capital is a lot better, in a lot more manageable position, in my humble opinion. So the balance sheet definitely looking a lot better. That being said as well, take a look at profitability here, guys. Profitability, once again, is very, very variable depending on which quarter you choose to measure, right? So profitability definitely very, very inconsistent. You can say that they made 42% net margins last year, but then again, the expectation for this year again is probably in the mid to low single digit amounts. Now, That being said, they do huge buybacks as well. This has been the case in point, guys. A lot of these companies, because of a lot of the case for these companies, because of the investment that they've received over the past couple of years, they've used a lot of money to buy back shares, and it just skews the data. You would think that the company is doing this organically, but it's really actually not. They do huge share buybacks to really get this EPS ramp going. Take a look at your EPS forecast right here. You will see the massive EPS growth that they're currently forecasting through 2027, but nobody is really sure whether or not that EPS growth will really come to fruition, right? It's really just based on current growth metrics. But if the industry slows down, or if they have potentially new competitors enter this market as well, or if existing competitors start taking some of this company's business model, well, this growth is obviously not going to sustain itself. Take a look at top line revenue. Once again, guys, top line revenue, a little bit tricky, right? You can see they're going down in 2024, back up in 2025, and should be growing thereafter. But once again, the growth of this company is just not so predictable and just not so consistent. So I would take those predictions with a little bit of a grain of salt. Now, they did sign a deal with Amazon to power the same data center that it sold off through 2032. So they sold the data center to Amazon, and then they said, well, by the way, we can still provide you with the power, which is one of their major contracts underway right now. In my opinion, guys, this stock is trading at roughly fair value right now, just because of how uncertain their future cash flows are going to be. Now, in terms of revenue growth, guys, 8.5% per year, which is decent if the growth prospects come to fruition, and EPS expansion is substantial at 38% per year. But once again, I would take this number with a little bit of a grain of salt. That gives them a forward PE at $119, their current share price of 35.1, which if we divide that by their huge EPS growth rate, it gives them a PEG ratio of about 0.92, which at a first glance does appear fairly decent. Take a look at your analyst projections here, guys. You only have 3 analysts covering the stock, and their profit targets are all between, the midpoint is about 139 all the way up to about 145. So really not that much meat left on the bone, even with the analyst considerations, right? So take that for what you will. Now, in terms of the technicals, monthly is looking very good, and the weekly is also looking very good. Continuous weekly uptrend, a little bit of consolidation here, and moving on for a potential trend continuation trade. Now, if I had to swing trade this one, guys, this one would pretty much be in the same line as the previous ones we were covering. Just take a look at where are your previous weekly higher lows, and we need to base the trade off of that, because if they lose a almost 1.5 year uptrend at this point, it's going to be significant, and the monthly consolidation is going to be quite significant as well. So that is the trade continuation that we're going to be looking for. If I had to take this trade under continuation, guys, I would pretty much be waiting for maybe a little bit of a pullback here. I know they're respecting the moving averages very well, but I would be a bit greedy with this one. If I can see 115, 114, would probably be entering the trade right there. The stop loss would have to go below 106, 105, just because that invalidates our weekly trend continuation, and that would be a breakdown on the weekly. And the upside profit targets, guys, I would go in line with the rest of our analyst expectations, higher end 139 to 145. So there is a little bit of a swing trade here, but in terms of a long-term portfolio add, really not my favorite company, guys. This is one of the smaller players in the space. So the longevity of the company and the growth of the company still up for grabs, right? Still anybody's best guess, in my humble opinion. Now, let's move on to one of our last ones that we're going to be covering, and then we're going to move on to 2 solar stocks. So we're going to be covering NextEra Energy. Now, this is another company that is directly attacking the renewable energy front. They are the #1 wind, solar, and storage developer in the world. So very, very large company in stark contrast to the one we just saw. They have a market cap of about $148 billion. So a very, very large company to say the least, right? Gorgeous long-term trend expansion in terms of this company too. Now, they have everything, guys. They have fossil fuels, they have nuclear, and they have renewable energy exposure. In terms of this company as a whole, guys, if I'm going to make an energy play as a whole, I really want to see a company with all 3 of these things at the same time, because of what I just showed you, right? We need to have exposure to everything, because electricity generation comes from all of these things combined, right? So we want to have a player that is well diversified, that is ready to attack any of which segment will be that could be the clear winner in a few years' time. Now, the company has good profit margins, but huge debt. So let's take a look at the balance sheet real quick, and I'll give you my determination on that. So you can see, guys, their net income margins are very good for an energy producer, right? Anywhere between 17 to as high as last year's, about 30 plus percentage points in net margins. That is very good. However, those net margins are going to be going to pay down all of this massive debt that they've been acquiring pretty much over the last 4 or 5 years. You can see that their debt since 2019 has gone up substantially, guys, almost a double from 43 billion all the way to about 73 billion dollars, which leads me to the point that I was making before. These installations require a tremendous amount of investment. And even when a company has decent net margins, right, they're bringing in about 7.31 billion in net income. That is only 1/10 of the debt that they have on hand. And obviously they can't use all of that profit to pay down debt either, right? They have to use it for a few different things, continuously building out more and more installations to stay ahead of the curve. So this is a substantial problem for the company, in my opinion, especially at current interest rates. Now, let's move on further. In terms of their EPS and revenue growth. Now, this is a more consistent company than a lot of the ones we just saw. Very consistent EPS growth, although the EPS growth percentage is quite small, and they do have very decent revenue growth as well. Huge bump in 2023, but you can see the revenue growth thereafter, guys, is fairly small, as it always has been traditional to every single utilities company, which is why all of these companies pay out a very decent dividend, right? They're not growing that much anymore. Revenue growth, 6.7% per year, and EPS growth about 9% per year. Decent, in line with the industry, nothing really to scream home about. Now, in terms of their forward PE, right, the valuation at these levels, at $72, forward PE is about a 21.1. Not that bad at first glance. If we divide it by the EPS growth rate, you will see that the company is trading at a 2.34 peg, guys. That is relatively high, especially for a utilities company. This is pretty much running some tech multiples right here, guys. There are far better deals than this in the market right now, in my humble opinion. I understand it pays a dividend. I understand it's a renewable energy player. However, there are better deals in the market, in my humble opinion, to say the least, right? So in terms of the technicals, however, could be a nice opportunity for a little bit of a swing trade opportunity, because now we have recaptured the monthly uptrend and we're currently above a huge area of congestion of the past. Take a look how much this area has acted as support in the past. And we can potentially derive a little bit of a swing trade location from there above all of our monthly moving averages, which is very nice. So a little bit of a potential swing trade opportunity coming into these monthly moving averages. Let's zoom in on the weekly. Weekly trying for the same thing, right? They're trying to set the weekly higher lows and trying to go for that weekly trend expansion. I like this area right here for a little bit of a swing trade, talking about 69 all the way down to about 66.5. The stop loss has to go below 61.30, because then that would invalidate this entire weekly trend rally. And if we pull back that much, we may just get stuck in a little bit of a tightening range, similar to what we had back here. Don't want to give back too much of the move, guys. I pulled this up pretty much on our usual stock rundown, right? If we pull down all the way to that 61 level, that'll be the bears recapturing about 70% of the move. And thereafter, the expected scenario is either a downtrend or at best a tightening range, but definitely a V shape from down there would be quite hard, which is why my stop loss would be there. And then obviously to the upside, we'd be targeting $79, $80 potentially, and then the all-time highs around the $90 mark. So there could be a little bit of a swing trade left in this one, if I do say so myself. But in terms of a long-term investment position, set it and forget it, guys. It's not my favorite play, to be quite honest with you guys. Just so many risks to the business. I'm not opposed to playing this one, swing trading here and there, but as part of a long-term portfolio in which we're really looking for growth, I mean, the company's multiples, guys, right now, just not that attractive in my opinion. And that's pretty much everything for NextEra Energy. Now, let's get into two solar plays that were requested. We're going to be going over Enphase and First Solar. So obviously the solar sector, guys, has been really plagued by high interest rates. That's because these solar installations are very expensive. Whether you're residential or commercial or even industrial applications, guys, most of these are built out using financing. Now, I understand Enphase is the company that only manufactures inverters, right? So they don't necessarily manufacture solar panels or do massive solar installations. Now, they do have investments in solar installations, but that's not their primary business. They are only there to manufacture inverters. If you don't know what inverters in, well, a solar panel takes in a lot of energy from the sun, and then that energy needs to be converted into electricity. You do that conversion with what's called an inverter. It's a little module that just converts raw energy into electricity. Obviously, there's going to be some energy that is lost during that process, but Enphase runs some of the more efficient inverters in the game. They are known to be the industry leader in terms of inverter technology because of their efficiency in energy conversion. So that being said, guys, Enphase has stumbled a ton, guys, and this is just a byproduct of the overall solar industry. Nothing against the company specifically. Just look at the ETF. The solar ETF, right? TAN, it has been down absolutely substantially. So it's really not Enphase's fault. Really, the majority of the industry has been down, especially the ones that are more tailored towards commercial and residential, such as Enphase is. The next company we'll take a look at for solar, they actually have more of an industrial take on the industry, which is very interesting. So the balance sheet is very decent despite the recent increase in debt. So let's take a look at their balance sheet here, guys. You can see in terms of their net revenue, guys, the revenues have been really declining, right? This is just a byproduct of the entire solar industry really slowing down because of higher interest rates. Taking a look at their balance sheet real quick, you will see that their balance sheet is not that bad. They only have about $1.32 billion worth of debt, decent free cash flow on a year-over-year basis. Even their most recent quarters have been thin in free cash flow, admittedly, but it's a cyclical business. They do say that the demand for solar will be resuming more towards the second half of 2025. So they do have enough cash to pretty much withstand the cyclical down spiral that the industry has been in, right? So they do have enough cash, decent free cash flow generation. I don't think debt is a major problem for this company. Now, the focus for them is on profitability at scale. That's something that they've been able to do very, very well at scaling upon their business in the last couple of years. So they are a profitable company at scale, and that scale will be expanding. Take a look at their EPS growth. 2024, transition year because of lower demand for the whole sector, and then thereafter should be continuing their expansion. And even in terms of revenue, guys, a little bit of a slowdown here in 2024, but 2025, 26, 27, they should be resuming. But there again, guys, it's not going to be the most tremendous growth in relation to 2022 and 2023 when this company was really booming, close to next to zero interest rates. That's what this company really needs to continue scaling up its operations and for just demand for its products to continue to resume. It needs lower interest rates. All these solar panel manufacturers that require this technology or battery storage that require this technology, well, they need lower interest rates to continue expanding their infrastructure and continue demanding Enphase's inverters. So let's take a look at their valuation here, guys, right? Revenue growing at a 15% per year, which is fairly decent over the next 2 years. And their EPS growth as well is about 22%. So very decent EPS growth. But once again, I'll remind you, we are coming off of a cyclical bottom. So take that growth with a little bit of a grain of salt, right? So that specifically at $99, which is really towards the lower end of where Enphase has been over pretty much the last 4 years of trading at this point, right? It's about a 35.6 PE on a forward basis, which is not that bad. If we divide this by their growth rate on EPS by about 22%, it gives them a PE ratio of about a 1.61. Not the best, not the worst. It is just okay, right? So that being said, even though the company is significantly off the all-time highs, the valuation is not that attractive here, guys. And that is just what happens when your EPS really, really slows down from 1 year to another. Wall Street is not willing to give you higher and higher multiples if you can't show that EPS expansion is consistent and predictable, right? Those are the main drawbacks of this company right now. That being said, I have been keen on playing this one more and more on the channel, just because I do believe that we are in a cyclical bottoming out process for the entire solar industry in a broad spectrum. And I do believe that these companies are telling the truth towards the second half of 2025. At that point, we may have already had 4 to 5 rate decreases, which will potentially be a bullish factor for solar investment to be going to the upside in terms of infrastructure installations, right? So that being said, in terms of the technicals here, guys, well, obviously now we are in a little bit of a monthly tightening range, and we're getting very close to the bottom of that. If we were to lose this, monthly downtrend is once again in order, and we will be targeting the $73 area. Now, that being said, I do believe, guys, that this area does represent a decent swing trade opportunity, especially if you're doing short puts, just because of how volatile this stock is, right? On any given week, usually you're able to write short puts about 10% below the current share price for some decent premium. And that is how I'm going to be playing the company, just because of how uncertain this whole industry is. I really only want to be assigned if a stock is giving me a 10% discount in any given week. That being said, take a look at the weekly, guys. the weekly is definitely not that pretty either, right? High level of weekly consolidation right now. And as I said, the previous support level, if we do break below this 95.17, the next one is a fair bit away, guys, at about 74, right? 95 to 74 does represent a steep drop, talking about 22 extra percent. It doesn't look like a lot on the chart, guys, but trust me, it is a decent amount, right? The true massive level of support, in my opinion, for Enphase, I'm not saying we're going to get there. But if you want to see Enphase with a cheap valuation at a huge support level, and keep in mind, I'm not saying we're going to get there. I know there's Enphase bulls on the channel right now. It's pretty much starting at about $62, down to about $50 would be the true massive level of support for the company, where everybody who then looks at it, if we get down to these prices, the PEG ratio will be very affordable. And this is when people will find it's a very good deal. As of now, judging by the share price action, people still are not convinced it's a very good deal. So the only form that I'm going to be playing this company at this given time, guys, is one of two things. I'll continue to play short puts in maybe the high 80s, low 80s, depending how quickly we drop. However, what we really need to see from this company, guys, is a net recapture of the weekly uptrend. Only then will I be comfortable starting maybe even call option positions, but I'm not going to be starting call option positions, guys, until I see an industry shift, which is favoring Enphase. And in my opinion, maybe that's not even going to happen until our first rate cut happens more towards the September area, which is really not that far away at this basis right now. So in terms of a long-term prospect for the company, long-term investment thesis, I like Enphase. I really do like them a lot. They have some of the best profit margins in terms of what they do, the niche that they operate in. And their energy efficiency for their inverters really cannot be ignored, guys. They are one of the leaders in the industry, that being said, right? So I'm really not opposed to starting a long-term position, but if I do start a long-term position, guys, I'm going to be very patient with my share purchases, extremely patient, maybe once every 2-3 weeks and small amounts until I build out a full position size, because even though I would not like to see this stock come all the way back down to the $75 range, but is there a possibility of it doing so? There definitely is, guys, and we cannot ignore that. The sector is just not in favor right now, and we're really bidding against everything, right? Monthly clear downtrend, weekly also in full bear control, which is why I say in this case in point, we really just have to do a better shot of DCAing. But if I want to take a little bit of a swing trade, guys, I need for a weekly bottom to be set, and I need to see a weekly uptrend resumption, so at least I have a few levels to base some trades off of. If I take the trade here, at least I could set my stop loss below the most recent low, and then we're going to be targeting upside targets to, maybe towards the 132, and then eventually the 180 levels, right? That's just how I would play Enphase myself, on either a long-term investment basis or just a swing trade basis, but I do like this company. Now, the last one we're going to be covering, guys, is First Solar, FSLR. And FSLR, contrary to a lot of other players in the game right now, have actually been performing very well. Why have they been performing very well, especially in this year specifically? Well, because they have a focus on utility-driven projects, not so much commercial and residential. So what First Solar does, guys, is they build absolutely massive solar installation projects, which then are used to generate utility-based energy consumption. So not towards they're pretty much selling all of their power on the utilities grid, right? So it's an industrial application. They're not targeting commercial. They're not targeting residential. They're just building massive infrastructure and then selling off their power. They are the solar industry leader in this field right now. Now, they also are currently expanding internationally. They're building a massive installation in India because the cost of production over there are very cheap. So nice to see them finally expanding internationally. Now, they have a very big focus on profitability, which is why they have focus on utility-based projects as well. Huge focus on profitability. And you can see, guys, contrary to a lot of other energy stocks that we've seen, their profitability over the last 5 quarters has been substantial. High 20s, even sometimes 30%, and their profitability on a year-over-year basis is getting a bit more consistent. Now, take a look at their balance sheet as well. Even though they do have nice profit margin expansion, how is their debt? And you can see here, stark contrast towards a lot of other companies that we were watching, no real debt to speak of. They have far more cash and cash equivalents than they do have debt ongoing right now on the balance sheet, which is a very good thing for the company. Now let's take a look at some of their growth prospects in terms of EPS and revenue expansion. Look at this EPS expansion, guys. absolutely massive, finally coming in to that exponential EPS growth ramp and revenue expansion as well. Stark contrast to a lot of other players that we were watching previously as well. So very nice revenue expansion over the next 4 years of 4 calendar years as well. So very, very healthy expansion on all fronts, and the company is very profitable. However, I just want to read one thing that analysts have been saying, which is why I've kind of got a little bit of a screenshot of what one analyst said about the company, which is what I wanted to show you guys, right? One of the potential limitations. It is crucial to understand that First Solar and other solar power companies are heavily dependent on sensitive changes in political and geopolitical climates, which is what we've said previously in this video. While the long-term narrative is undoubtedly towards higher solar adoption across the world, and most likely with this form of power becoming dominant through 2050, the road to this end goal is not clear, with several conflicting interests and political objectives potentially inhibiting growth for extended periods of time. In other words, guys, very, very cyclical business and highly dependent on every single factor that I outlaid in the introduction of today's video. That being said, it is one of your stronger players in the industry, and I would not be opposed to taking a little bit of a stab at it for those reasons. Take a look, guys. Revenue expansion, double-digit growth, 17%, very good. EPS growth, 27.5%, very, very good as well. And I like the fact that they focus on more on utilities where the grid needs power, right? For all of these corporations, they focus on industrial applications, not so much residential or small commercial, which is where most of the money is for this current narrative. Now, valuation, guys, at $222, the current stock price right now, we are looking at a PE ratio of about 16.3. That is not that high at all. And when we divide this PE ratio by their EPS growth, you can see their valuation is very, very attractive right now. Have to give it to them, guys. Even though we do have to take a lot of this energy growth, especially renewable energy growth, with a little bit of a grain of salt, guys, this PEG ratio cannot be denied. Even if they were to cut this growth expectation in half, they would still only have a PEG ratio of 1.2, which is towards the lower end of what I'm looking for. Very, very attractive valuation, healthy balance sheet. So this is definitely a play that I would consider. That, plus the fact that we were in a great, great, great technical level here, guys. Gorgeous currently monthly uptrend, right? Beautiful monthly uptrend, and we're now retesting prior all-time, well, not all-time highs, because the all-time highs were back here in 2008, but we're not going to talk about that. So let's just call it, for all intents and purposes, previous relative highs, right? So looking very, very good for the potential bounce, breakout, retest of this range, and maybe even run. So I would potentially be keen on maybe starting a little bit of a feeler position right here with a very low valuation and with the direction that the company's business model is heading into. I like it, guys. So that being said, this current area of support is pretty much all the way down. I mean, you can extend it a bit further, but for all intents and purposes, it's pretty much down to the $200 level, right? So anything here, here 220 down to about 200, I would probably be keen to making a little bit of a swing trade on it, right? If you want to get a swing, pinpoint swing trade, just watch this daily downtrend. As soon as your daily downtrend has found a bottom out, how do we know the daily downtrend is finished? Need to see the daily uptrend formation. So I would be looking in this area right here that we're coming into. Heavy, heavy, heavy prior monthly resistance, which should now be monthly support, all the way down to maybe 195, this monthly 12 EMA. I would be looking for the eventual recapture of the daily uptrend. I would be very patient in waiting for it, because once that daily uptrend shift happens, it's very easy to build a position, going for the daily uptrend breakout, going for the weekly trend resumption breakout as well, and the potential monthly uptrend breakout as well. We're going for trying to snipe this one with the change in the daily. It all starts with the change on the daily. So that being said, that's what I'd be looking for, a swing trade. If I was looking for potential some long-term position building, I really don't see any problem right here. I know the company's run a lot, even since the early part of the year, right down here in the 160s. I know it's ran a lot, but the valuation is relatively decent. So building a small position here and dollar cost averaging as we maybe dip into the levels is not that bad of a proposition. But if I were to build a long-term position in this company, I would really put it at no more than about 2-3% of my entire portfolio. I want to have some solar exposure, guys, but I'm not going to bet the farm on it. Even with these great metrics, guys, it's just such an unpredictable industry as a whole. But I really do believe that this stock can have some decent upside. And analysts, for the most part, guys, do agree. Price targets all the way from 285 to about 356. So the stock definitely does have a decent amount of upside. So that being said, guys, that's pretty much everything I had for you guys in terms of our subscriber request energy rundown. As I said, any constructive criticism is well appreciated, guys. I don't deem myself to be an expert in any regards in this field. I'm just pretty much giving my rudimentary analysis and overall thesis that is currently behind the renewable sector right now. So hopefully this has been insightful for you. If you have any if you enjoyed this video, guys, consider dropping a like. Would really appreciate it for the growth of the channel. And also consider subscribing to the channel if you're new too. We do these subscriber requests every single Saturday, and we do daily market recaps Monday to Friday as well. So hope to see you back in the near-term future on the channel. And then lastly, guys, if you have any questions pertaining to this video at all, or if you want to engage in further discussion with me, definitely leave some comments down below, and I'll be happy to look deeper into the sector and everything, look more into competitors and whatnot. But just understand, I'm by no means an industry expert. It requires a tremendous amount of years in the game to really have the expertise required to analyze these things properly. And I don't deem myself to be the best person for that, but you guys wanted it, so I figured I should do it just coming from my perspective. So hopefully today's video has been helpful. Hopefully you guys enjoyed, and I'll see you in our next video, which will probably be tomorrow, the top 5 options plays. So take care, guys. I'll see you soon, and peace.